Welcome to Big Picture Earnings Analysis. Today we're looking at Snowflake's Q3 Fiscal 26 results, the earnings report, investor deck, all the analyst chatter.
Right. And our goal here is to get past that big headline beat and really dig into the forward guidance that caused so much volatility in the market.
Okay, so let's start with those hard numbers. Snowflake definitely surprised to the upside.
Oh, absolutely. The EPS came in at what, 39 cents?
Yeah, 39 cents when the forecast was only $1.31. That's a huge surprise, almost 26%.
And the top line was strong too. Total revenue hit $1.21 billion, which sailed right past the $1.18 billion everyone was expecting.
So you've got nearly 30% year-over-year growth. By any normal measure, that's a fantastic quarter.
A fantastic quarter. It beat consensus right across the board.
So if the numbers look so good, why did the market seem so confused? We saw that initial pop, right? The stock jumped a couple of percent after market.
It did. It went up to about $262 for a minute.
But then it just reversed hard.
And that initial confidence just evaporated. The stock ended up dropping more than 8%. It all comes down to the expectation game.
Okay, walk us through that, because for most people, a 2.5% revenue beat sounds like a win. Why wasn't that enough for Wall Street?
Well, a company like Snowflake is, it's priced for perfection. The valuation assumes hyper growth, not just good growth.
Right.
And when you look closer, the product revenue, that's the key metric that shows actual customer usage, it only beat by 2.3%.
Okay.
Now compare that to the last quarter, where the product revenue beat was almost 5%.
So the market is seeing a slowdown in the size of the surprise.
Exactly. They're not just looking for a beat. They're looking for an accelerating beat. For a high-growth stock like this, a 2.3% product revenue beat just isn't that jaw-dropper the street wanted to see. It's solid, but not spectacular.
Okay, so let's step back from that market noise for a second and look at the actual health of the business.
Yeah.
The numbers under the hood, they seem incredibly strong. Product revenue still hit $1.16 billion.
Which is still 29% year-over-year growth. I mean, that's a durable number. But what's even more interesting for the future is the RPO.
Remaining performance obligations.
Right. And for anyone listening, just think of this as contracted future revenue. It's money that customers have already agreed to spend, even if they haven't used the service yet.
And that's where we saw acceleration. It hit $7.88 billion, which is up 37% year over year.
That's the signal.
So why is that gap so important? 37% RPO growth versus 29% revenue growth. What does that tell you?
It tells you they are locking down much larger, longer-term contracts. It means the pipeline of committed spending is growing much faster than current consumption.
So it's like a buffer for future quarters.
A fantastic buffer. It shows that customers are making bigger and bigger bets on the platform, which is a huge vote of confidence.
And they're still bringing in new customers at a record pace.
A record 615 new customers this quarter. The total is now over 12,600.
Which, in this macro environment, is pretty impressive.
It really is. It shows that, data and AI are just non-negotiable projects for big companies right now, and they're landing the biggest fish.
Right, the high-value customers. Almost 700 of them are now spending over $1 million a year. That's up nearly 30%.
And the land and expand strategy is clearly working. Look at the net revenue retention rate.
Still stable at 125%.
Which is an elite number. It means your customers from last year are spending 25% more this year.
But is stable good enough? I mean,
Yeah.
For a high-growth company, you almost want to see that number climbing, don't you?
That's the critical question. The market probably wants to see it closer to the 130s, so stable could mean a bit of maturation, or maybe customers are just getting smarter about how they spend their credits. But when you see it next to that accelerating RPO, it suggests that new commitments are growing even faster than the historical spend.
Let's talk about efficiency, because this often gets lost in the growth story. They really expanded their margins.
They did. The non-GAAP operating margin was up 450 basis points. That's a huge jump to 11%.
So how are they pulling that off, while also pouring money into AI?
It's just smart management discipline. They've been very deliberate about hiring, about optimizing their own cloud spend, and crucially, their product gross margins are holding strong at almost 76%.
So they're proving they can innovate and be profitable.
Exactly. And that's what the market is demanding right now, sustainable, profitable growth.
Okay, so that brings us to AI. This was the real pivot in the narrative this quarter. The CEO basically said Snowflake is at the center of today's enterprise AI revolution.
And this is where it gets really interesting. They hit a major AI revenue milestone.
The $100 million run rate.
$100 million AI revenue run rate. That means they're on pace to bring in over $100 million a year just from AI-specific usage.
And they hit that a full quarter earlier than they predicted.
That accelerated timeline is huge. And remember, because this is a consumption model, that $100 million isn't just a software license fee.
Right, this is based on real usage.
It's real-world consumption. Companies are actively using their AI tools, like Cortex and Snowflake Intelligence, in their day-to-day work. It's tangible proof of value.
So AI isn't just a buzzword for them. It's actually driving sales. They said it influenced 50% of new bookings.
50%. Think about that. In half of all their new deals, the customer's AI roadmap was a key reason they signed. That is a profound shift.
And their main product here, Snowflake Intelligence, had the fastest adoption ramp in company history. What is it that customers are actually doing with it?
It basically makes it easy to build and use AI agents right on top of your own data inside Snowflake. And the use cases, the aha moments, are really powerful.
Okay, give us some of those examples.
So TS Imagine, a big financial services platform, they built an AI agent using Snowflake Intelligence.
Okay.
That single agent now handles complex data queries and customer support tasks that management says is equal to the work of 8.5 full-time employees.
Wow. 8.5 FTEs automated by one solution. That's a game changer.
That's the kind of ROI that gets a CIO's attention. Then you have a totally different example with Fanatics.
The sports apparel company.
Right. They're using it to unify data from over 100 million fans. Shopping, gaming, betting, all of it. And with that, they're building these incredibly valuable, targeted advertising networks.
So one is for internal efficiency, the other is for top-line revenue generation.
Exactly. And then you have the USA bobsled team using it to analyze performance data to get a competitive edge for the Olympics. It just shows how versatile the platform is.
And it seems like their strategy isn't to build all the AI models themselves, but to partner.
That's key to their moat. They're integrating with Google for Gemini models, with Anthropic, and they have that big partnership with SAP. It makes their data cloud the central model-agnostic hub for enterprise data.
Or let's circle back to the guidance, which is where all that market anxiety started. What are they actually projecting for Q4 and the full year?
For Q4, they're guiding for product revenue between $1.195 billion and $1.2 billion. That's around 27% year-over-year growth.
Which is a bit of a sequential slowdown from Q3. And that's what spooked people.
That's what spooked them. But, and this is a big but, they raised their guidance for the full year.
Right.
They raised the full year product revenue guide to $4.446 billion, which is a solid 28% year-over-year increase.
And the CFO was pretty clear that the full year number is the one to watch.
It was. He basically said the annual guide is the most meaningful signal, and that you have to look past the, the quarterly ups and downs.
Why is their business so prone to that quarterly volatility?
Because it's a pure consumption model. Their revenue is tied directly to real-time usage, unlike a subscription. And they give a perfect example of this.
The hyperscaler outage.
Yeah, a single outage at one of the big cloud providers cost them between $1 and $2 million in revenue this quarter.
Wow, just like that.
Just like that. Something totally outside their control instantly hits their top line. It really shows you the risk baked into this model.
But looking past that, what about the long-term runway? Is the core business, the non-AI stuff, starting to slow down?
Well, the CEO had a really interesting take on that. He said they are super early in migrating data from old on-premise systems to the cloud.
Golly.
He estimates only 15 to 20% of that work is done.
So there's still 80 to 85% of the enterprise data out there to be moved.
That's the argument. And if that's true, it suggests a decade or more of durable growth, even before you factor in all the AI upside.
But it's not without risks. What did management point to as the big challenges?
Well, they were very clear about competition. It is intense. You've got the big cloud providers like Google with BigQuery and AWS with Redshift, and then, of course, Databricks.
Right.
They also mention, market saturation in some areas and just how dependent they are on those big strategic partnerships staying strong. It's a tough race. So when you put it all together, Q3 was really a story of fantastic execution. They had accelerating RPO, record customer growth, and they proved they can manage costs with that margin expansion. And most importantly, they proved they can turn AI innovation into real money, hitting that $100 million run rate a quarter early.
So the real story here isn't the slightly underwhelming guidance or the stock drop. It's that Snowflake has built this powerful, super low-friction way for companies to start using AI.
Exactly. Customers don't have to make some huge upfront financial commitment. They can just dip their toe in and pay as they go.
Which brings us to the final thought we want to leave you with today. Since this consumption model means customers face almost no risk to start using AI, and it's already influencing half of all new sales for Snowflake, how quickly will that expectation of risk-free adoption completely reshape how all major enterprise software is sold? How long until this try-before-you-buy model for AI just becomes the new standard for everyone?